Hello traders. So in this video, I want to quickly give you a brief description between the difference between spot trading and future trading. So as you can see on my screen here, we have the spot trading. Once you come to, if you're using your computer, once you come to this section trade, you see we have spot and we have future trading, right? And like you know, the spot trading involves taking instant trade without any leverage, right? While the future trading involves leverage. So let's dip in into this, the two difference between this spot trading and future trading for those that don't know it, or for beginner traders. And in our next video, I'll teach you how to trade spot trading perfectly. Right? So spot trading involves the immediate purchase or sales of an asset at the current price. So let's say you come into your chart like this in spot trading, and like I said, you come to trade, you go to spot trading, and like the definition goes that it involves immediate purchase of or sale of an asset, right? So once you come to this chart, you come to markets, right? Let's say this is BTC or any pair you feel like purchasing. You come to this stage, you come to market, you put in the amount you want to buy. Let's say $50, $100, $1,000. And so on, just putting the amount you want to buy, or use percentage. This, let's say 5% of your total capital, 25% of your total capital, 50% for 25. Just drag it to the percentage. You can use 100%, meaning you want to buy 100% of your capital. That means if you are having a 1,000 in your accounts, USD in your account, meaning you want to buy a whole 1,000 USD. So with this trading, there is no leverage. You are buying with your money. I hope you get. While the future trading involves contract to buy or sell an asset at a predetermined price on a future date. The actual transaction take place at expiration or unless closed earlier. So you see the two differences. In future trading, you buy this asset using a leverage, right? The broker can decide to give you a leverage of any amount. Let's go to future. Let's go to future. Now we are in future, and same BTC. You can see same BTC. So, but with this, you can use a leverage, meaning you have, let's say, 1,000 USD, but you can buy more than 1,000 USD. Right? You can buy up to 5,000 USD, depending on the leverage you collect. You can see here is the leverage section, and you can add any leverage of your choice from 1 to 100, depending on the exchange. Some exchanges, they will give as high as 200 leverage or above, right? So, as you know, with everything good as it seems, there are risks involved. So the second difference between spot, in this particular video, I'm not teaching you how to trade it. Yes, I'm just showing you the difference between spot trading and future trading. I hope you get this. So the second difference between spot trading and future trading is that on spot trading, traders own asset once transaction is completed. This asset is being owned by the traders. Once they bought it, it is now automatically theirs, right? But on future trading, traders do not own the underlying asset until the contract is settled. I hope you get it. On future trading, you don't own this asset. This asset still belongs to your broker. Why? Because the broker lend you money to buy it. So if this trade goes against you, this broker can decide to cut you out or liquidate you in a way it will not affect their own money. I hope you get. So it is not your asset because you borrowed money to add to your own money to purchase this asset. I hope you get. So that is another difference between spot trading and future trading. Our number 3 difference is the leverage and margin. I already give you hints on this. So in spot trading usually requires full payment of the asset with your own money, no leverage or less using margin trading. I hope you get. There is no leverage on spot trading, except if you decide to use margin trading, which involves borrowing of money. So in future trading typically involves leverage, meaning traders can control large positions with fraction of the contract value, increasing both potential gains and risks. So the higher the profit, which is the higher the leverage, the higher the risk. You see how this is going hand by hand. So that is why you see that some traders prefer to just do future spot trading, because it doesn't involve high risks. Yes, there is no trade that doesn't involve risks, but the risks in spot trading is minimal than the risks in future trading. In spot trading, like I earlier said, you own these assets. So even if the market goes against you, no matter how, even if this market goes against you, no matter how long it takes, no matter how many weeks, how many months or so, this asset belongs to you. If this asset will hit up in future, then you will recover your money back. If the market goes down, the value of your asset goes down, right? I hope you get. If the market goes up, the value of your asset goes up. But in future trading, if the market goes down and your money, the money you have, can no longer hold the market, the broker will automatically liquidate you and remove you, because they don't want it to touch the money they lend you. But if the market goes in your profit, good and fine, both you and the broker will benefit, giving you higher chance to get bigger reward, right? So the both of you will have something good out of this trade. But if it is going against you, believe me, the broker will take you out, because he doesn't want it to affect his money, and you get liquidated and your money is gone. Your money is gone forever. Your money is gone. I hope you get the difference. So that is why risk management is very important in trading. So number 4 difference between spot trading and future trading is spot trading is mostly common among investors who own the asset for immediate use or long-time holding. I hope you get. Spot trading can involve long-time holding. You see all the big agency, the government agency, and so on, usually involves themselves in spot trading because they do long-time holding. I hope you get. And in future trading, it's used for speculation, hedging against price fluctuations or arbitrage. You see the difference here? So it is left for you to choose what you want to choose. So as if you are a future trader, you know that, okay, probably maybe you don't want to hold the market for long. You need to really apply proper risk management in future trading. It's really need discipline and proper risk management, or else you keep blowing your accounts, you keep getting liquidated all the time. I hope you get this. Then our number 5 on the list is spot trading is that the settlement is immediate or within a short period. The settlement in spot trading is immediate because you own the asset, you can sell it at any time. I hope you get, you can sell it at any time. Whether you're in loss or you are in gain, you can just decide you want to sell this asset because you own it already. But in future trading, settlement happens at contract expiration unless the position is closed earlier. So in future trading, if you decide to close the position, either a loss or in gain, that is when this contract is end. Or they liquidate you, the contract will end. I hope you get, or they liquidate you, the contract is gone. Then Number 6 on my list is risk exposure. The risk exposure in spot trading and in future trading. In spot trading, the risk is limited to the amount you invest. The risk is limited to just the amount you invested. If you have a $1,000 account and you bought an asset worth $100 and probably the assets get robbed or so, it only affects the $100 you bought. I hope you get. And even at that, if, for example, this same asset come up, maybe get boosted in future, your money is still there and you will still make out your money, right? Unlike in future trading that the risk is higher due to leverage, as losses can exceed initial investment. So once you invested in your future trading, you invested just $100 and the market is going against you and probably use the cross margin strategy. Once this market gets against you, it liquidates your $100, for example, and start getting into your remaining $900. Remember, let's say we have a $1,000 capital. It will liquidate that $1,000 capital, and before you know it, your account is gone. Your account is gone. So it is left for you now to choose what you think is best for you. If you must go into into future trading, you need to learn proper risk management, please. You need to learn and apply good proper risk management. So talking about which one to choose, for example, is depending on you. Depending on you, right? Spot trading is suitable for long-time investors and those who want to own assets outright, right? And future trading is better for traders looking for short-term gains, hedging or leveraging capital. You don't have good capital, then future trading is for you, right? You just want to make quick money. Remember, quick money, quick blowing of accounts. While in spot trading is mostly for long-time holders. You can see some people, they are spot trading and holding an asset for years. They can hold, let's say, BTC for 5 years. They can hold it for 1 year. They can hold it for some months. They can hold it for some weeks. You get? So, tell me in the comment section, which do you prefer? Do you prefer the spot trading or the future trading? Let me know in the comment section. And if you are yet to join our Telegram channel, you drop updates, free signals on both Forex and crypto trading daily. I'll drop the link in the description of this video. Kindly join and like this video, share this video. Don't forget, I said in my next video, I will teach you how to trade spot trading, because I see a lot of people don't really understand how spot trading works. So I'll teach you how to trade spot trading, and I'll also do a video on the strategy to use in trading spot trading. So see you in our next video. Bye-bye.